Okay, welcome everybody. Thanks a lot for joining in today. Today is One Day, One Topic webinar, and it's about trying to anticipate what's going to happen in 2017. I'm Giuseppe Basile, also known as the Fibstalker, and I will be your host in the next hour here till 9 a.m. EST, 2 p.m. GMT. Thanks for joining in. JM Anthony, there is Mauricio as well. So today I'm going to touch on how smart and dump money is positioned in 2017. Smart and dump money are the two group of players that I follow, and I think that they are very, very important when it comes to what could happen next in the major markets, particularly the market with high volume. Okay, I'm being asked to hold. I think that tell me when to go. Okay. So welcome back. I'm Giuseppe Basile, also known as the Fibstalker. Thanks for joining in, and you're very welcome. Thanks to the FX Street team who has set up this event today. It's One Day, One Topic, and the topic today is trying to anticipate what's going to happen in 2017, how the major players are positioned, or it is supposed would be positioned in 2017. Particularly, I follow two group of, I attempt to model two group of traders, the smart money and the dump money. And in my trading, risk management is my trader's job number one. So if you are watching the recording of this webinar, please stop it here and read the disclaimer here. The commentary, the trading ideas, and the chart provided in this webinar should not be relied upon as a substitute for extensive independent research which should be performed before making your investment decisions. Okay, so the information I'm giving is merely provided for your general information. So I will not spend time on myself. I'll just remind you that I started Fibstalker Trading.com in 2012, and I have a number of initiatives, including the Fibstalker Members Coaching Program. Now it's at its fifth session, which has started at the end of November. The next session is going to be February, March. And I recently started the Fibstalker Winning with Algos community, where I offer a free course on algos and how we can model algorithms and their effect on price. So if you're interested, you can go to Fibstalkertrading.com, and let's get into the content here. I present the charts, and I offer my view on morning, Anthony, and welcome everyone. Thanks for joining in today. As I was saying before, I actually offer my view on what I see and for 2017. I just want to briefly introduce the players and the beliefs that I have about these players in the market. So there are two players, and two main players. Obviously, there are different groups within these players, and two groups. One is what I call smart money, and the other is dump money. So who's smart money? Well, smart money is the group of people who know what they're doing, large banks, professional traders, program trading, algorithms, and there are different families and types of flavors of algorithms When I speak about algorithms, I don't speak about high frequency trading. I speak about algorithms like program trading, which actually participate on all time frames, including larger and smaller time frames. In fact, it is possible to observe these algorithms also down in the tick chart on the futures, for example, SP 500 E-mini futures, or the majors Forex futures as well. So that money, on the other hand, I believe it's the traditional tech analysis crowd, the trend following people who use trend following systems. Also discretionary crowd, the people who believe that they can tame the market and discretionally enter. Typically, these people do not have any stops or sometimes even an idea of stop. And of course, there is the group of people who believe, and these are all retail people who believe that trading is cool. Now, the smart money or dump money by themselves, do not win or lose all the times, but this is a strong belief I have. I believe that smart money initiates and leads market moves, while on the other hand, dump money obstacles price and follows market moves. So often, it's either wrong or it's late, and so this is a very strong belief. And I believe that in order to win in this game, we ought to stalk the market, the smart money, and that's the reason why you will see an assonance here between this and my nickname here. So again, smart money initiates and leads, dump money obstacles and follows. And if you want to learn more a little bit about how I model smart money, there is the winningwithalgos.com. You can go /start. You can get your free mini course on this material here. And I also offer Fibstalker Trading Signal service and have my coaching as well. So let's look at some of the markets here, and I will switch to my charts here. Give me a yes if you can see the charts. And I will start, as I mentioned, I will cover some major markets, and we will work really mainly here on the larger time frame. And as you know, as you can see here, I model dump money or part of the activity of dump money using moving averages. While to model smart money, I use a subset of Fibonacci retracers. So for now, we will keep the dump money out of the picture here, also because, as we mentioned, from the belief I provided before, dump money actually follows price and tends to obstacle price, but what actually drives the market, it's smart money. Now, this is the continuous contract of the SP 500, and for the way the continuous contract is calculated, sometimes what happens is that you actually keep looking at the chart as some of the level change, some of the past level change. So the last month is always aligned with the front contract, but there can be some change. So only for this specific market, I will also make reference to the SPY, which is the ETF that track the cash. Now, those who know my work know that the models that I use apply to the market if you go back to the 70s, and even if you go back basically to the to 1900, to the down futures. So the implication there is that algorithms have actually modeled or incorporated something which is actually fundamental about the market. If these models work also before computers were even invented. Okay, now I don't want to get into that. I have, if you look for material on FShoot, you'll find a lot of that material. What I will say, and what is important to us, is the fact that in 2003 and again 2009, once again in history, we actually tested a 50% retrace from zero. So from the very beginning of the inception of the equity market in US to the highs in 2000s. And this has happened a number of years, and it's still on today. So as you can see, and the reason why I'm using SPY, I explained that before, is because it does not shows the anomalies of the continuous contract, the way it is calculated by TradeStation here. But the only reason why I'm bringing this up is that I want to make you notice that this market has traded the 78 SPY level, and the low here on the SP 500 E-mini future was 667. You will remember probably in 2009 if you were trading. And what happened here is that this level has traded twice, it's been confirmed in 2009, and now it has reached the first target. It has reached the first target actually in 2013, okay? Sorry, in 2014, early 2014 here. And this target is the 1950 area, 1930 area in the SP 500 E-mini. So where is this market going, and where it is going to go, very, very probably continue to go in 2017? Well, we have a second target above, okay? And that's where we have to, what we have to look at. And that second target above is in the 2500 area, and for the SPY would be 252. For the SP 500, this is the level, 2500, this is the level that I'm actually looking for. And this level might not be that far after all, given the way this market is moving. So my anticipation here, prediction, if we can use that term, I don't like using the term because we are not in the business of making predictions. We are in the business of managing risk when it comes to trading. And but if I'm asked to specify where this market might possibly go, well, 2500 is my target. In fact, I have a leveraged ETF position, which I will remove at 2400 here. And that's where we see this market moving. This market is also, and this is also better visible on the SP on the future, and that's the reason why I use the futures, because the futures are really the truth when it comes to market, and I use them, and I'll show you also in the dollar index what's the implication in the dollar index and what the majority of people are seeing at the moment, and what we should be looking at as well. So thanks Mauricio and Anthony there. So so as I mentioned, as this market went above that first target, it's now kind of in an extended mode, and the models I use work on mainly high volume market. For this index, I use the SP 500, and when we switch to the SP 500, I can show you this very same chart. And as I mentioned before, there is that anomaly that this low goes much lower here. In reality, that's only related to the way these contracts, the continuous contract is calculated, okay? So you will see a lower level here, but when in 2009 this market was trading there, it was, the low was 667. So This market is extended, and if you watch my analysis in FX Street, we have modeled and captured in October 2014, we captured this low here. And a lot of people were worried, they didn't know where the market was going, but the market was going to trace into next measure move here, 1770, and that area broke price into the first target and then caused, and then there was profit taking, a lateral move 2014, and another same anchor new high as traded here. And we captured this level before the fact. If you go back and watch my videos on FX Street or on my website, you will see these levels traced well in advance. In fact, as you can see here, when we don't see where the market is coming back and we see highs, we can trace that that high to high. And if the market gets back to that level, we know that there is a potential for participation. Okay, so there was a potential for participation, and it was clearly shown 4 times end of August here, September, and beginning of 2016. So why I traced this measure move? Because this measure move, it's an inner measure move of that move that we saw on the weekly, and he has brought already price 2 weeks ago to the first target here. Now, as you can see, there is a higher, a second target, which helps price into that 2500 that we mentioned before. So anticipation for 2017 is to see this price continuing higher in the coming weeks, whether in a very, very aggressive way or in a sequence of less aggressive move higher. First, getting it into 2394, 24, and secondly, there will be the 2500 larger target from the weekly time frame, and at that point, we will need to see whether this market will correct or will just continue higher, like it happened back in the 90s. So this is one of the most dramatic and aggressive bull market in history here, and there is no indication that this market should actually reverse here. And there are a lot of people who are worried about this market, but remember always that the market climbs a wall of worries, and the more people I hear speaking about a reversal, the happier I am being long here, because that happens all the time. People were worried here, people were worried here, people are worried at new highs, and the market climbs a wall of worry, and there is also a lot of money on the sidelines, and when that money will come in the market, this market might go even much higher. In fact, some people project 3,500 for this market, believe it or not. Okay, so despite all the crisis and problems, there is really a lot of money which is out of the equity market, and that's not the time when we have to worry, when there are a lot of people who call whistleblower who call for a reversal. Of course, anything can happen in the market. Okay, I'm not saying that could not happen, but before it happens in this current situation, and even in the most dramatic situation like in 2007, look at how much the market has retraced laterally before starting a move lower, and the same thing happened in 2000s actually. So when we bring in the smart money here, we get even a rosier picture, because you can see that not only is the smart money supporting this price, but dump money is supporting this price too. And you can see it when the price gets into these areas. These are two simple moving EMAs. exponential moving average. One is 13, the red one, the other one is 26. Okay. If you have any questions, obviously, please shoot. Welcome, Costa. And okay, so there is no worry from that point of view. This market has to get below these two measure move here, and they have to turn as well. So I'm not saying that that's going to happen. I'm just saying that that didn't happen. If it has to happen, and will require months, if not years. So as a lot of people are still worried about this market, I'm happy about it. So you have to be you have to have initiatives when people talk down the market. It's when the janitor and the taxi driver will be talking about the markets that we will need to worry. So to me, at this juncture, there is very little to worry about. Okay, if you have any questions on the equity, I'm going to close this first review here on the SP 500, and I will move to the dollar index. Dollar index is very, very important. It has been the main. It has been on the news all the time in the last few months here, and this market was given for doomed. A lot of talks on the debt situation in US and whether that's solvable or not. I think that a lot of this down talking, it's really economic warfare. And the point is, I'm not saying that the situation in the US is rosy or is going to be rosier with Trump, but we have to respect price and what price is telling us. Okay. Now, at the beginning of the second decade here, we saw this market, and again, I'm going to remove the dump money here because I want to focus only on what I see the smart money is doing in this market. Okay, so we had this lateral move. We have a partial range here that actually was still pushing this price lower. As we can see, price came into this area, and the bears, smart bears, say, no way, we don't want that US dollar higher. And then the market came and kind of prompted and tested two more times this market. No way. Eventually, this market in end of 2014 here came above this level. This was the start of a dramatic move here, which is the first leg of what could be a 3 legs move. And currently, we are in the second leg. The second leg is typically known to be the longest as well. So if that's the case, we are going to see this market much, much higher. In fact, I'm going to tell you where I possibly this market. So once that lateral move here with a resistance above ended, and again, that resistance was smart money saying we don't see this market or want this market above this level. That lasted basically from mid-2011 to end of 2014, 2 years and a half. The market started a move higher, very, very steep here, and so it went into an extended mode. And as you can see, then smart money kept initially supporting this price at 94.30 for 6 tests: 1, 2, 3, 4, 5. These traces are not random; they are based on the models that are used to model smart money. However, at the beginning of 2016, I mentioned this break here. Something might be changing in the dollar, and at that point, I had the full retracement in mind here. I say, if smart money doesn't support that level, it's possible for this market to retest 89.80, and this was worrisome. What happened after that, though, is that in the next few weeks, the market started respecting again this level, and some of these people call this a reverse head and shoulder. To me, it is not a reverse head and shoulder. It is interpreting what algos are doing and smart money is doing on very, very important levels. Okay, so once that started, I remember there was also an interview on FX Street, and someone asked, is a rate hike possible? What I mentioned is that if 94.50 is respected, this market can continue higher. And if this is respected, this would anticipate a rate hike. And in fact, the market just continued higher like a missile here, and you know what happened after that. In December we had our rate hike, and that was anticipated by price here. The point is that I didn't know how the price would actually move higher. My only observation was that this level here was now respected. Okay, so and you can find that on FX Street as well. That's something I mentioned in one of the interviews. So the point I want to make here is not to say that I was right, or it's not about ego. It's about understanding where this market is going. That's much more important. Actually, that's the only important thing. Ego is definitely not important when it comes to trading. So the point is, now we have smart money that will be watching this market at 106.40. If you review the weekly show, you'll see that I mentioned this 106.30 a number of times, and that's where we are going. It's just a matter of understanding how we are getting there, meaning whether we will retrace or not, or just this market is going to pass into that level. But this could be a first level where smart money could actually take a stand and say, okay, what we are going to do with this market. Notice though that this is an extension. So the facility with which this market will reach 105.20 could be followed by even easier continued move higher into 110.15. And in fact, I believe that this market eventually will break above 113.03. And remember, the second leg, if this is indeed a second leg, and we will have a third one, it's not impossible to imagine the dollar index back to 130 here, which would mean that the euro would go back to 80.8. Okay, now is this going to happen? I'm not sure about it. What I believe is that we can anticipate. We cannot be sure of anything in trading, but we can anticipate that the 106 will trade in the first months of 2017, and then also the second target 110.60 and possibly 113.03. That breaking 113.03 will actually basically put this market back into the potential for 130 again. Okay, that would mean very low euro, difficulty for advantages and difficulties for different countries. Certainly, Italy, Germany. So this is what we see in the dollars. So that means that all the majors, as also the minors, which trade against the dollar, will actually keep suffering as we move into 2017. Okay, so that's what I see for price: 106.30, 110.60, and eventually 113.03. We have the setup for that, and the market is respecting that setup. There's no reason to believe that this market is going to reverse out of the blue. Obviously, anything can happen. It can be a geopolitical event or anything, but That's the way smart money is positioned. And dump money, which follows an obstacles, has been responsible for, in a way, intervening in this price in the 92 to the 94 area here, and actually kept pushing this price higher. Okay, and there's no participation at the moment, but obviously whatever retrace the dollar index will put on, or might put on, will be actually will be greeted with more longs or more buys from dump money. Okay. Any questions so far? You can write them on the Sure. So I have to finish at 8:45. That's perfectly okay, not a problem. So I'll be a little bit faster here. So when we look at silver, I like to use silver much more than gold to track the dollar and the effects of the dollar. This market has seen dramatic prices here, and recently it came back to a previous area of support. The market moved higher, and also broke a sequence. Also broke a sequence here, but then it traded these shorts here, showing that there was indeed control on the dollar, and this has the potential to push these prices much lower. If we look at the chart here, and we extend it a little bit, we will see that this price can actually move much lower here. Let me change the see if we can see more price here. So there is a first target at 1090, believe it or not, and this market has been very technical in a sequence of measured movement. Now started moving in extensions. We had 50% retrace, we had another 50% retrace. So we actually framed this price in its move lower, and then the market showed an inner measure move on the daily. I'm not going to show this because we're on the weekly here, and they hit the first target, and now it's pushing well below that 1580, which was my target in the last trade, and that's where we're going to see short-term this market. And after that, this market could trade in extensions here. So I see at the beginning of the year this market going down to 1090, 11. That's not impossible if this market continues. But mind that below that, there would be a second. There would be a second target here, and as aggressive that might seem, that's exactly the level where Buffett has bought around 5.70 for silver. So silver seems not to be affected by the news related to superconductors and all this. The technology that made a huge use of silver is gone. That was photography in the 70s, in the 60s, in the 70s. So this whole idea that there's little supply. There's also little demand for this metal. So mind these two levels, 1090 and 580, are levels that we might see in 2017. Then I wanted to review some majors here, starting from the euro. I think it's important to understand what's going on here. So I think that there are a lot of people that believe that this market will right away continue lower. A lot of people are trapped in new lows here. And so let's quickly see at what I can see here happening. And as you can see here, this market on the weekly recently has traded a 50% retrace, which found participation on the day of the electoral vote here. And when we trace from highs to lows, we can see that area of participation, which broke price into first target and second target. And when you see profit taking from these levels, that shows to you that these models are real, that indeed there are agents and algorithms and professional traders who actually take profit at these levels. It happens all the time. I'll show you a brief example on US Japanese yen if we have time. Profit taking here, a lot of people got short here right at the low, looking at the break of previous lows, and that's a big mistake, because when you look at the break for previous low, you're very close to that second target. It's a little bit like when you trade any type of breakout or breakdown, you're very close to that first or second target, and that's the reason those techniques do not work well in modern markets. So what can we expect next? We can expect this market to continue in extensions, and in fact, very short term here, from lows to lows. The 106.20 is the level that this market could retrace to, and that would become short. Now, there is a second target on the weekly for this market. That second target brings this price in line with what we said for the dollar index, and believe it or not, the second target, the first target was 109. The second target is going to be 093.48, which is the end of the euro, maybe. And I think we have only 2 minutes here, so Adinda, you can stop me anytime. And I wanted to review the US dollar, Japanese yen, and a couple of other, but there won't be time. I will only say that the US dollar, Japanese yen traded the 50% retrace 170, and there's targets above. And again, this is in line. So the first target is going to be 137.60. That's where we're going to see this market. So I hope this brief view here was interesting, and if you want to know a little bit more about how I model the algos, you can go to winningwithalgos.com/start, and I hope this information is going to be useful for your trading 2017. And I took the chance to wish you a Merry Christmas and a happy holidays and a great new year, trading or non-trading year, to you and your loved ones. So thanks a lot for being here today, and I look forward to keep reviewing this market with you. Okay, so thank you very much, and thanks FX, Jordi, Costa, Mauricio, and Anthony JM. Thanks for being here. Thanks Adinda and Mauricio for organizing the event. Thank you very much. Bye-bye now.